So you probably logged on to this video reading the ridiculous title and wondered, what sort of crazy Dave Ramsey fan am I going to listen to right now? You're about to listen to the opposite. While I have nothing against Dave Ramsey, Marko, Scotty Kilmer, I've got a little bit of an issue with the over-exaggeration that typically takes place when people talk about why leasing is such a bad idea. What I want to do in this video is really focus in on why these experts talk about leasing in a very general sense is very, very bad for you to make up your decision whether or not you're going to be purchasing or leasing a car, and why every single car lease is unique every single month. What is happening, guys? Ari here from Boston Automotive Consulting, and in the description below you're going to find various resources so that you can shop around for the very best deal on a brand new car. You'll also be able to shop around for insurance rates, get your auto credit scores, as well as shop for an auto loan. If you haven't already, please consider subscribing, because this whole channel is going to teach you everything you're going to need to know so that you can negotiate your best possible deal. Now, Graham Stephan was my favorite of all the people that I listened to on YouTube talking about car leasing, and a lot of his advice has to do with the fact that, guys, nobody's going to keep a car in this day and age for longer than 10 years. And if you are keeping it, then you're making the best financial decision. However, you don't have a car that's worth anything. So just wanted to clear that up. Even though you've got a car that's fully paid off, you really don't have anything special, and you probably own something that wouldn't fetch more than a couple $1,000s at auction. Now, with that being said, I've got a bone to pick with Dave Ramsey. He constantly talks about auto leasing, and he constantly over-exaggerates the terms of the most typical auto leases being anywhere between 60 and 70% depreciation in the 3 to 4 years, and that's not true. Typically, any auto lease you'll see is between anywhere the range of 35 to 50% for depreciation over the course of 3 to 4 years. And the typical interest rate that one can see, an effective interest rate, is typically about 5 to 6%. And what he's referring to is the whole amount of interest that's being charged. Typically on an auto lease, if you're seeing 2% APR being offered as the promotional APR, on a finance, you can probably see 2% as being the money factor or the interest rate on the lease, because the interest gets charged on the sum of the lease payments as well as the buyout. That's the effective interest rate of, say, 4-5%. Now, let's use a very, very good example to debunk Marko's math strategy of using a $17,000 or $18,000 Honda Civic and a $180 lease payment. If we've got a Honda Civic brand new, he's basically using a used Honda Civic as opposed to a new one as the substitute for the lease payment. But the fact is that he used the Honda Civic that was valued at $17,000 and a lease payment for a Honda Civic that was valued at $23,000 or $24,000. So that comparison that he made was not really an accurate comparison. A lot of these people, a lot of these style experts are using these types of cars to really emphasize the fact that you buy the car, a low-cost car, pay it off in cash, keep it for many, many years. And while that's very, very easy to say, most consumers nowadays are using that capital. Instead of buying a car in cash, they're financing it at 2% and freeing up that capital for other smarter investments. Why would I put down $20,000 in liquid cash against the car that I'm being offered a 2% interest rate on, when I can convert that $20,000 into a much higher rate of return? This is just talking strictly about the pay in cash scenario. Then, on that end, why would I keep this car for 10 years? I'm going to be paying $18,000 for this car, and I'm going to be keeping it for 10 years. So let's just break down the math on that scenario. We got $18K. We're dividing it by 10 years. That comes out to $1,800 per year. Divide that by month. It's $150 per month. If I can get a Honda Civic lease for $200 per month, times 12, times 10, it's costing me $24,000 over the course of 10 years to consistently have a brand new Honda Civic as opposed to $18,000 to have a 10-year-old Honda Civic or a rapidly depreciating Honda Civic because of all the dings, dents, miles, etc. that are racking up year over year. So the very cause of my concern is that when talking about an auto lease as if it's the dumbest thing you can do, use accurate examples, use accurate depreciation, and don't just focus in on the fact that you have nothing at the end of an auto lease, because typically at the end of a 10-year auto purchase, you probably have nothing too because of how badly that car is depreciated. Now, if you're saying, no, you could take care of a car to make it last for longer than 10 years, I'm sorry. I don't think that you've ever been to Boston, New York City, or LA where cars are depreciating by the second between potholes, between traffic, between minor fender benders, between all the garbage that takes place. And speaking of fender benders, I want to see you try to sell a car for close to its value, for close to its KBB value after there's been a Carfax incident report on it. Most of these people online that are giving you advice on whether or not you should purchase or lease and say, no, leasing is fleecing and you get charged a whole lot for excess wear and tear and all this stuff, don't even consider the fact that the leasing company takes on the liability of you getting into an accident with their car and not charging you for the amount of depreciation that takes place once that Carfax report has seen an accident get listed off on it. When you're considering an auto lease and an auto purchase, take for example the latest email that I got from one of my dear subscribers, James. He asked, you have a specific situation with a Lexus RX where you leased it in one situation and you purchased it in the other situation and you totaled it. God forbid you totaled the thing in situation A, you just walk away from the lease, but in situation B, what happens? Do you negotiate with the insurance company and try to get it so that they'll zero out your balance? If you don't have gap insurance, that's not going to happen. You're going to pay the difference. But what about in the situation that it doesn't get totaled? And after a few years, you decide, hey, I want to trade in this Lexus, but there's an accident report listed off on its Carfax, and I'm not seeing nearly close to what the value says on KBB or whatever of what my car is worth. I'm not getting this value or nearly close to it at all. What's up with that? Well, you depreciated the car quite a bit when you got into an accident. And when you leased the car, nobody opened their mouth. When you bought the car, they certainly did. And in leasing, you didn't get charged. They didn't charge you a cent for you getting into that accident. Well, why is that? Because when these financial experts tell you leasing is a really, really bad idea and leasing is fleecing and it's robbery, etc., they don't focus on the benefits that leasing actually provides and the liability that these companies take on when they're leasing you out a car. Finally, people like to talk about you're limited in the amount of miles that you can drive. No, you're not limited in the amount of miles you can drive. If you're gonna go over a certain amount of miles, that means that the rate of depreciation is a lot higher and they're gonna charge you for it at a rate of about 15 to 25 cents, depending on how expensive the car is. And if you purchase the car, you can drive as many miles as you want, right? No, because you're also depreciating your car. So if you're not paying for it on the front end in the terms of, a bill getting sent to you for the excess miles, you're certainly going to pay for it in the long term by rapidly depreciating your car and not getting nearly close to what you expected on a trade-in value or a resale value. So I don't understand why all of a sudden, if you're just driving your car around, you're driving around for free. No, you're not. You're rapidly depreciating your car. I guess I really did appreciate Graham Stephan's example where if you're going to make the best financially sound decision, buy a used car, try to hold on to it for about 4 or 5 years. But if you're looking for the very, very best and latest and greatest in technology, the lowest payment, try to get a car. This is my advice, by the way. Try and get a new car with a substantially low money factor or APR on the lease so that you're not paying exorbitant amounts of interest, and try to get one that you get a decent deal on one, like Dave Ramsey likes to get his cars at invoice. Definitely make sure that you're doing mathematical calculations on every single unique vehicle that you're considering for that month. Don't just listen to very generalized advice and exaggerated terms such as my dear friend Dave Ramsey likes to give out in his videos. I'm not actually friends with him. I just don't want to piss off anybody that likes Dave Ramsey. I don't mind him. I think he gives out good examples. I just don't think he should be giving out car leasing examples unless they're very, very specific to each and every car he's talking about. Again, you guys, links in the description below where you can check out prices for brand new cars, get good deals on them, as well as shop around for insurance rates, get your auto credit scores, as well as shop for an auto loan. And if you found this information useful, please consider subscribing. Thank you so much for watching, guys. We'll see you next time.